Welcome to Real Estate Radio Live, an informative and engaging podcast discussing everything you need to know about the world of real estate. Your host, Joe Cucchiara, provides you with insight and guidance on how to buy, sell, finance, and invest in real estate. He also offers real estate tax management strategies, new construction advice, home improvement tips, and much, much more. And now, to guide you around the world of real estate, here's your host and Real Estate Radio Live team leader, Joe Cucchiara.
Hi, welcome in. Joe Cucchiara here with Real Estate Radio Live. Thank you for joining in and thank you for continuing to listen to the podcast. I want to make an apology in advance here. I am going to start the podcast back on a regular basis. I have to apologize because of all the changes and logistics going on with our businesses here over the last year or so. The podcasts have been very infrequent, too infrequent, and I'm getting a lot of requests from kind requests, I'll have to say, which is nice. Getting a lot of feedback, emails, some requests by those that are kind of wondering, why there's not more frequent podcasts. So I apologize in advance for that, and I will commit to getting back to doing one podcast a week on the real estate related matters, specifically to the Bay Area, but also to other parts of the United States and what's going on. There's a lot of changes taking place. I'm going to give everybody an update on that today. And I do have to say I miss the podcast and miss the live radio. Hope to, there's a chance actually we're going to start doing live radio again here in the next couple months. So I will keep everybody posted on that. For the thousands of people that still continue to download the podcast each and every month, thank you very much. I appreciate that. I really do. And appreciate all the kind words and feedback I get as well. So today I'm going to cover a couple of different things. One is just an update in the housing market, what's going on in housing. I think everybody is euphoric and wondering if this is ever going to end, and yes, it will. So we're going to talk a little bit about that, and also some major changes in financing second homes and investment properties a lot of people don't know about, and it's just another way for Fannie and Freddie and the government to steal money. And to me, they're just so darn greedy. And I'm going to talk a little about that. So really three things today. Talk a little bit about the housing market, some of the changes that are coming in pricing when it comes to buying and financing a second home or investment property. And also rates in general, some of the things to keep an eye on if you've taken advantage of these low rates, and second home markets. There's going to be some big changes in second home markets, I really believe, considering I track this and watch this stuff on a regular basis. So quick summary. So let's jump into the housing market in general. I'm going to speak to, because we work with different companies, and by the way, this show is brought to you by Bundle Select. Forgive me for doing that too. I have to remember to remind everybody about our sponsor. This show is brought to you by Bundle Select. Bundle Select partners with corporations to offer their employees discounts and savings and a concierge service on lending, real estate, buying, selling, financing, relocating. It's great information. It's a great service. If you're listening to this podcast and you're an employee or someone in HR and benefits, doesn't matter the size of your company, doesn't matter if you have 50 employees or 50,000 employees, have them go to bundleselect.com. That's bundleselect.com and have them sign up, do a demo. It's really a great employee benefit. There's no cost to the employee at all, and you get discounts and savings on real estate, lending, relocation, and some great programs. It's a benefit just similar to health that a company offers their employees, medical, dental, 401k. This is a tremendous benefit with a huge savings. A lot of people are taking advantage of it. So again, if you're an employee, doesn't matter the size of a company, whether you have 50 employees or 50,000, encourage your HR benefits people to go to bundleselect.com. That is bundleselect.com. All right, the housing market all over the place is just crazy. To compare if any of you were part of the market back in 05, 06, when it was really peaking, I think the peak was 2007, and then it came crashing down because of the mortgage meltdown and all the nonsense financing that was taking place in those days. Everybody knows about that. I'm not going to waste anybody's time going over all that. But it feels a lot like that timing when the market was so frothy. I mean, it's getting so expensive These homes are being run up. There's multiple offers. There's 50, 60 offers sometimes on a property. They're overbid by 15, 20, 30% of the asking price. It's really unbelievable. So let me give you a little history of why it's happening, why I believe it's happening. So number one, a lot of people, well, it's pent-up demand, and people have been in lockdown and the pandemic. Well, that's a little part of it. But so let me give you the specific reasons why we're having this mega interest in housing right now. Number one, we still have low inventory throughout the United States, specifically the Bay Area as well. Low inventory, number one. So there's not a lot of inventory, supply and demand. That's rule number one. Number two, keep in mind the stock market has had its biggest run in the last 7 to 10 years, which means people are more wealthy than they have ever been before. There are people right now that have gained 50, 60, 70, 80, 100, and 120% on their investments over the last 5 years. And I mean that, just simple math. If you had $1 million in your retirement and investments account, there's a chance 5 or 6 years ago, just by virtue of the stock market and the run-up in the stock market and what's been going on, that $1 million could be 2 million plus right now for people. That's just an example. So why that plays a big part in the housing market is that people are taking advantage of the wealth building over the last several years. They're also taking advantage of taking some of the money off the table, so to speak, and mitigating risk. So when I say mitigating risk, I mean when you have a lot of money invested, and there's a lot of people that would suggest, hey, listen, you've made a big gain over here in the stock market. Let's take some of those profits and some of those let's take some of that off the table and let's reinvest it. Let's get diversified. Let's get more diversified. So let's take some money out and let's buy some real estate. So that's what a lot of people are doing. They're taking money off the table out of their investments and they're reinvesting in what? Most people reinvest in real estate. And because you can invest in real estate anywhere now, it used to be people were nervous about investing in real estate where they didn't live in or understand a location. That's gone. I mean, you have people investing all over the place. So that's another reason why. Large run-up, people are a lot more wealthy. They're feeling a lot better about what they have to invest. They're diversifying, mitigating some risk, taking some of the money off the table. They're investing in real estate. So that's another reason why we have this huge run-up. In addition to that, there is a huge, I think it's last I read, almost 85% more second homes being bought this year to date than there was the last prior couple of years. Well, most people do know why that's happening. Ever since the pandemic came along, most of us are understanding now that we could work from anywhere. We don't need to be in an office. We don't need to be living somewhere. We don't need to necessarily be somewhere 24/7. So what has that triggered? That's triggered people in explosive second home markets. So again, if you think second homes around the Silicon Valley, we think second home markets would look like Lake Tahoe, Carmel, Monterey, Napa, places like that. Santa Cruz, places near the beach, those types of things. So those would be second home places. But then you also have a lot of people that are buying second homes in Montana, Idaho, North Carolina, Florida. I could go on and on, different places. So there's this huge explosion. And I think the part that surprised most people, and it still does surprise most people, it doesn't mean when you follow the data and the statistics behind this, is that you're thinking, why is the economy acting the way it is when we're still in the middle or we're coming out of a pandemic? The reason why most of us are now like we're turning around, we're going, wow. So now it's easy to understand because many sectors, many industries not only didn't get hurt during the pandemic, they thrived and they had record profits during the pandemic. What I'm sad for and what most people are sad for, and is really depressing and upsetting, is that we've seen the restaurant industry, the hospitality industry, the travel industry take a huge hit. Those poor people and companies have been devastated, among others. And if you weren't in any of those industries, it's likely that you benefited during this pandemic. Look at high tech. Look at what's happened in high tech and a lot of other industries during this pandemic. Record profits. Unbelievable. None of us would have thought this. I think when this pandemic hit, one of the reasons the market took a correction and people kind of were sitting back going, "Oh, how is this going to affect me in my life?" Well, people found out fairly soon that business was still as usual in many different cases, other than face-to-face, shaking hands, traveling for meetings. Business was still pretty much business as usual. So that's the other reason for this huge interest in housing and what's going on. And people are purchasing for those reasons. And these are in my opinion, the 3 or 4 different aspects of why this market is as expensive as and crazy it is, and where we're getting heated up. So the next question is, and by the way, we do business in states all over the United States. So I don't care if it's Colorado, North Carolina, Chicago. I can tell you almost everywhere, not everywhere, but almost everywhere. I would gather to say 80 to 85% of the housing market throughout the United States is like this. What I mean like this is that low inventory, houses don't stay on the market, things are being overbid. It's nuts. I've never seen anything like this before. Now, I've seen things like this before in Silicon Valley. I haven't seen things like this in other states that we're experiencing right now. So what does this mean? I would say be careful. And if you've listened to my podcast for years, I've been doing this for 11 years, my belief has always been this. If you plan to hold real estate for long term, it's almost impossible. It's not guaranteed, but it's difficult to get hurt if you plan to own real estate long term. So right now, I'm going to take you through this exercise a lot of us went through in 07 and 08. I'll give you an example. I had a property that I paid I shared the story before. I paid $1.3 million for in 2005. When 2008, 2009 hit during that big crash in the mortgage meltdown, I'm sure at one point, now I never intended on selling that house, right? I mean, it was my primary residence. I never intended on selling it. But at one point, if I would have had to sell it, that home was worth less than $1 million at one point on paper in the market if I would have had to sell that home. I never had any intentions of selling it. I still own that home. And so fast forward today, that home is worth over $2 million. So this is just one in a millions of examples. So you get what I'm saying. If you buy real estate, and if you're some of these people that are buying real estate right now and you're concerned, and I hear this all the time, Joe, I'm concerned. There's a lot of people that call and consult with me and talk to me for hours and hours. I call it market therapy. It's market therapy. And I go through the same exercise with them I would do, and I'll do with you today on this podcast. If you just bought a house today and you're stressed out and you're concerned because you paid a premium, let's say you wanted to pay 1.3 for this house and you wanted it really bad and you got ran up and you end up paying 1.5 million for this house. So in your mind, you paid a $200,000 premium for it, right? So 10%, whatever, you thinking, okay, gosh, that's stressing me out. I'm concerned about it. I do understand the concern, but I would tell you this. If you take a long-term approach on that investment that you just made, I really do think you will be fine, and you'll find out you'll be fine. Now, there's no guarantee, but what do I mean by that? So if you just purchased a home for 1.5 that really was worth 1.3 and you paid a premium for it, we've all been through this years past. Believe me, we could speak to this because I've been through it personally. I do financing for thousands of people a year. Me and my team, I get it. So if you plan to hold this property or this real estate long term, I could tell you there's a really good chance you'll be fine. That house you just paid for 1.5 for, it could be in the next couple of years, this market takes a bit of a correction and you're looking at your home on Zillow or some other places and the real estate agent calls and says, hey, your home's now worth 1.1 or 1.2. Just as you're listening to this today, it helps you carry it and go back and listen to it. I can't guarantee anything, but I could assure you that you have a good chance that if you hold on to real estate long term, you'll always be in pretty good shape. What do I mean by long term? My idea of long term is 7 to 10 years. And the reason I choose 7 to 10 years is because it's usually somewhere in an economic cycle of 7 to 10 years. I think 3 to 5 years is a little bit short horizon because there's some things that could happen. But if you're buying this house, just bought this house in 2021, and you fast forward 7 years, right, to 2028 or 2030, I know it sounds kind of interesting to say that. If you fast forward 7 to 10 years, I think you're going to be fine. I really do. So please try to keep that in mind. Now, if for those, I hear this a lot too, for those that are stretching themselves, this is what I want to say, be careful. For those that are stretching themselves and you're buying a house because you're in the frenzy and you're in the fray and you really don't love the house, but you're buying it because you're afraid you're going to lose out on something, that's a different story. If you find a house you really like, this is my opinion, been doing this for a long time. If you find a house you love or you really like and you see potential in, don't be afraid of paying a premium for it, because you'll probably hold it long term and it's a place you really love and enjoy. Okay. Where people get in trouble, I've seen this before. You get into this frenzy. You're following everybody else. You see the media, you hear your neighbors, you hear your coworkers saying, "Oh my God, I got in this place. You better get into real estate now. It's going crazy. You're never going to be able to afford it. It'll never come." Nonsense. Don't get caught up in that. I always tell people, put pen to paper instead of getting emotional about these decisions. If you're out looking and you feel yourself being ridden with anxiety and stress because you're thinking, "Oh my God, homes keep going up. I haven't found the home I like." And now you start thinking about, I see this. This is, believe me, listen, please, don't. My suggestion would, do not purchase something just to purchase it because you feel like you're losing out if you don't like that home. I know that sounds strange. Some people go, "Well, Joe, why would someone do that?" You'd be surprised. People do that. They do it because they say, I need to get into the market. I'm going to lose out. I need to get in the market. That's not necessarily true. So for those people, I'd say be careful. My recommendation for the people that are looking and they can't find something they at least like or like quite a bit or love, don't just buy a house to buy a house. That's a recipe for disaster. It really is. Because here's what's going to happen for a lot of people. They're going to buy it. They're going to buy it at a premium. They're going to move in. They're going to go, "Oh my God, the backyard sucks. We're close to a street. Oh, I don't, what did I do this for?" You're going to beat yourself up. I'm just saying, be careful not to do it just to do it, not just to buy a house to buy it. Bad mistake. Recipe for some problems down the road. So try to avoid that. All right. So I'm going to wrap up the housing market by just saying that the next question I get a lot is, "Joe, when is this going to stop, or will it last forever?" So I could tell you this with 100% certainty: this will not last forever. That I know. This will not last forever. If the next question is, "Joe, how long is this going to last, or how long is this?" I can't tell you that. No one could. If they were, they're BS and you're lying. I will tell you that there's signs right now. We study this every day. There are signs right now that things are starting to cool off a little bit. What do I mean by cool off? We're seeing, instead of 20 or 30 offers, we're seeing 5 or 6 or 7 or 10 offers. We're seeing prices go on the market a little bit lower. We're seeing homes staying a little bit longer depending. So if I got the monitor and the meter and the big crystal ball out right now, I'd say we're getting close. We're getting close to the peak here. I'm convinced by this year for sure, sometime this year, whether it's fall or winter, I think it's going to be at the end of the summer, maybe September, October, maybe even wrapping up 2021. We will start to see kind of a flattening and a slowing of the market. I really do. Now, some people think that, and I do, when you look at the numbers, this could be this could be a record year for people financing purchases. So that is true. So when you see that and you say, well, Joe, that doesn't make sense. You say things could slow. Those two things could be equally true. So there still will be record purchase this year. I have no doubt about that. But keep in mind too, construction of new homes are trying to keep pace. And for the last 2 years, they could not keep pace. And then the pandemic hit, and then it slowed even more because, you just couldn't build in the pandemic. That will eventually catch up. And so where you're going to run into problems, here's where you're going to run into problems. These people, if you're buying in Nevada, Arizona, Florida, I'm not sure about Florida. Florida's a little different. But if you're buying in places that have millions and millions of acres still to build on, and there's a ton of inventory that's going to be available in the next couple of years, those are the places that will get into trouble first. If you're talking about a place like Silicon Valley, it's a tough one. And here's why, because there's no space to build here. You have to buy existing homes. There's very little new construction around here. So it's a different story. This leads me to my recommendation, and what I would say, be careful with the second home market. That second home market, I think if someone says, Joe, where's the bust or where's the potential problems in the next couple of years, here's my strong belief. I believe that the second home market will take a hit in the next couple of years, and it'll get hit big. And here's the reason why. You've had millions of people running emotionally, spontaneously, reactionary, buying second homes in places because they're all excited that I don't have to work where I live. It's out of control, which is fine. But that's going to come back to roost. My point is this. I really believe that these millions of homes that have been second homes that are being bought near vacation areas, I don't care if it's to a certain extent Tahoe, Napa, Carmel, Monterey. Then you have a lot of people buying in Idaho and Montana and places like this. Mark my word, the next couple of years, I wouldn't be a bit surprised if those markets have a huge downturn. And here's the reason why. Let me finish up with this. Someone would say, well, Joe, that doesn't make any sense because they're good loans. The loans aren't going to crash. Or that's all true. So I'm not talking about mortgage meltdown. People have skin in the game. So that part. Here's what's going to happen, in my belief. The reason why that second home market and rental home market is going to be cause for concern in a couple of years is this. There's been such a huge run-up with people buying reactionary, emotionally, that I believe that in the next year or so, when people go back to the office, when life gets back to somewhat normal, and it will, I'm telling you, it will, when it gets back, people will start second guessing and wondering why in the world they bought $1 million home in Montana or by the beach when they only use it 2 or 3 times a year and not even that much. And they realize the cost behind it. Now I know someone's going to come back and go, well, Joe, I solved that problem. I'll just rent it. That's true. You could take a second home and convert it to a rental. But remember when everybody starts doing that, remember what happens. Then that market softens too. So here is my belief is that be careful for all these people that have been spending like crazy with second homes because you really believe that you're going to work from the mountaintop or on the beach and you'll never go back to the office. You're going to put your flip-flops on, put your baseball hat on and never see the office again. That's not going to happen. We're going back to the office. I know it's not going to be full 100%. I get that. I can almost guarantee you in the next year and a half to 2 years, I will bet that 50, 60, 70% of people that were in offices were back in offices. Will it ever be the same? Likely not. No. Will people be working sometime home? Yeah, I believe in all that. I'm not saying it's going to go back to the way it was, but it will. And when it does, when people now aren't visiting their second homes the way they thought they could, that is when that market will start showing a correction. That is my prediction. The great thing about these podcasts is you have them recorded and you have a record to be recorded, or whether you're right or wrong. And believe me, both have taken place. So that is my prediction for the housing market, the second home, rental property. Be careful. I always think, I'll close this out and switch gears here in a second. I'll say again, as I led into this, real estate's always a great investment. Just be careful. Try to make it a long-term hold, because anytime you're forced to sell real estate before you want to, there's a chance you could get burned or lose some money. So be careful of that. All right, let me quickly talk a little bit about interest rates and what's happening, speaking of second home and investment properties. So Fannie Freddie, most of you might know, I think it was late last year. Yeah, late last year, in their greed, just because the mortgage industry had one of the best, strongest years ever in the last 15 to 18 months. Fannie Freddie, and this is my common sense opinion, and I'll make it simple for you. Fannie Freddie, the governing body, manages mortgages, mortgage backs, all that. So they saw all these banks having record years. And you guess what they were thinking? They were sitting around in the board meeting going, whoa, why are these lenders having record years and profits and we can't benefit from this? So they decided to put a 50 basis points, a 0.5% cost on every single refinance that's done. Ladies and gentlemen, that is hundreds and hundreds and hundreds of millions of dollars of profit that goes back to Fannie and Freddie because they're greedy. That's number one. So now they're doing it again, and most people don't know this. So now they're making it more expensive for rates and fees to buy a second home in an investment property. You might say, well, what does that mean, Joe? So what they've done, specifically if you're only putting 20% down, or when the loan to value is higher and it's more, they're putting an additional fee on there. And I'll give you an example of what that looks like. So someone might say, well, what does that look like? So before this happens, if you buy a $400,000 property, and let's say you finance, $250,000 or $300,000, that new mortgage today, with these Fannie and Freddie changes, is going to cost you anywhere from another $3,000 to $4,000 easy to finance that loan today with the changes that it would have been 6 months ago or 3 months ago. So to make it simple, your costs went up about 100% to finance a second home in a rental property, the way they've structured the rates and the financing now. And it's just, to me, it's frustrating. We're in this business and we do, most of you know, the team and I do primary financing, and we do a lot of it, and we help thousands and thousands of people, and we're proud of that and we enjoy that. But at the same time, everybody is trying to get their hand in the consumer's pocket at a time when I'm not so sure it's that simple, or it should be that easy. And so I would just say this: if you're getting ready to buy a second home or an investment property, just work with someone you trust and have a better understanding, because you can't avoid some of these fees if you put more down. So if you're financing a new second home or investment property, some of these fees can be avoided depending on your down payment, okay, and credit scores and some other things. So just be real careful. Either way, it's going to be more expensive. So just know that when you're investing and you're looking at these properties. Lastly, interest rates, they're still outstanding. You could still get 30-year mortgages for right around 3% or less. You could still get 15-year mortgages for the mid 2%. This is the one that people don't understand. You could still get jumbo financing in the low 3% range, which is remarkable. In some cases below 3%, which is remarkable still. So when you hear in the media that rates have gone up, they have gone up a little bit from off record lows. That's true. But they're still, historically speaking, extremely cheap. And it's a great time to use that money. Believe me, if you could finance an appreciating asset, I'm not going to get into this today because this is another show. I'm a huge fan of financing with low cost of money with an appreciating asset. Real quickly, it's this simple. You get a home for $400,000, you get a $200,000 loan on it. That $200,000 loan costs you 3%. That $400,000 home appreciates not at what you borrowed, but at what the value of the house is. So if you have a 5% appreciation on a $400,000 house, your appreciation is going up greater and your cost of money is so cheap. It's a great investment. So I would say this, if you have a home, multiple homes, whatever, take a look at them right now. It's still a great time to refinance. The last thing I'll say, it's a great time to refinance, pull cash out if you're going to put it back into your house. If you have to do a remodel, if you want to do an add-on, add square footage, anything that's going to be investing back into your home, I would encourage you to do it and do it sooner than later, for sure, because I think it's a great time. All right, we're going to wrap things up. I want to thank you again. I'm super excited about 2021, and I guarantee and I promise the listeners I will be doing the podcast at least once a week, depending on what days. It just depends on how busy we are, but I will be doing them once a week. Again, as usual, love your feedback. If you have any ideas for shows, we'll try to have more guests on now that the pandemic has subsided a little bit, and we'll do some of those soon as well. Remember, for more information, I don't care what it is, if you need advice on a mortgage, a house, financing, buying out of state, whatever, reach out to me. You know how to get me, joe@reradiolive.com. Or I know I'm crazy, but I'll give out my cell phone number if you want to text or call me, 408-838-9060. That's what I'm here for. Again, 408-838-9060. If I could help you with anything to do with financing, lending, real estate market, if you need referrals on a real estate agent, financial planner, CPA, we have all those resources for you. Remember, that's what we're here for, is to help all of you consumers and to be a resource for you going forward. All right, thanks again for tuning in. Thank you again for all those loyal followers. Thank you for the thousands of downloads a month. And I will be with you once a week going forward here again. Take care. Have a great afternoon.
You've been listening to Real Estate Radio Live. For more information on today's program, visit RERadiolive.com. That's RERadiolive.com. Subscribe to our podcast. Discover more at RERadiolive.com.